Hello, everyone. Mike Arnold here, co-founder, Pat Trading Partners, along with Bob Iacchino. Still working out some of the kinks with the green screen and the new audio. Trying to upgrade the channel every chance we have. By the way, if you're new here, please do consider subscribing, ringing the bell, and hitting the like or dislike button. Just trying to get the little, there we go, the video going up there. This is sort of a complex topic today, but I think it's important. So even if you don't get all the nuances to this, please do consider sticking around to the end for the summary, because it will help you, especially during the monthly option expiration cycles, especially the quarterly ones, when you get some massive option expiration volume. And the reason I'm putting this out, this is another edition of Mike's Crazy Classroom. It's going to talk about, we just had the January option expiration, and that doesn't really matter what month it is, but one of the things was there was a lot of chatter going on. We're in negative gamma versus positive gamma, and there's a gamma flip, and what does all that mean? Let me switch cameras here and get over. We're still dealing with the multi-camera setup here. Sorry, I have multiple computers, multiple monitors going on here. This is my trading rig that's sort of converted into a streaming rig and video rig. That's why I'm still working on the lighting. All right, by the way, we're using a tool from Macro Option. Macro Option, great little company here, puts out these spreadsheets. They're extremely inexpensive for what they do. Again, I am not sponsored by them. I actually own their products. I've paid for them myself. Hopefully at some point we'll be able to get an affiliate thing going with them. I just really like their spreadsheets for modeling stuff and playing with stuff, especially, after market hours, just putting a bunch of different positions on, checking your overall profit loss, your deltas, your gammas, your thetas, your vegas, and really helping to model positions when, out of the heat of the moment, and really understanding what options are doing. All right, so let's get in the meat of it right now. Let me just do a very quick recap. We're not going in depth on all the Greeks. The Greeks are delta, gamma, theta, vega, rho, and then there's some other ones we're not going to get into, derivatives. But essentially, delta is the rate of change of the option. Gamma is the rate of change of the delta. So if delta was the velocity, gamma would be the acceleration or deceleration. Okay. Real quick, I have modeled right here, and we're going to get more. I'm modeling this just prior to expiration of January that just happened. I'm sort of going back in price. We're just going to do stock, but this is applicable to stock, futures, indices, any options. It's just easy for me to model stock right now. I'm assuming the stock price is at 250. We have one long call position with essentially one date expiration. So you can roughly see the delta at the money. So we're at the strike of 250. Our delta should be about 50, and that's about where it is. What does a delta of 50 means? It means the option is going to increase in price half as much as the underlying. If the delta was 20, it would be a 20% increase. A delta of 70 would be a 70% increase. As you see, as I go up in price, since I'm long a call option, the delta will go up, and it will go up approximately the amount of the gamma. Now, as I go up a full point, it's going to go up slightly less than the gamma. As the more we get into the money, it's going to go up even less. I'm not going to get into all the nuances here, but if you really want to model it out, you'd have to go up fractions of a point like this. I'm not going to go up 10 cents because it will take way too long. So let me get this back to 250. There we go. I go up a buck. Now, let me go jump back. Sorry, I jumped ahead a little there. You see our gamma is 15, so the delta is going to go up to approximately 65. So if I go up $1, you can see it going up to approximately 65. Now, as I go up another buck, it's going to go up slightly less than 14. Again, that's because we're getting deeper into money, and this is on a full point move. And again, I'm not going to get all nuances, but it's going to go off roughly to about 68, 69. I mean 78, 79. So there you go, 78. How do we get there? Just under 14 plus 65, that gives us 79, again up 78 because it actually go the deeper in the money, and this is modeling a full point. You'd have to get into fractional points to model it a little more accurately. So now we're at 78. So that means this option, as it gets deeper in the money, is going to move about close to 80% of the underlying in value. So if the underlying goes up $1, this is going to go up roughly 80 cents. Now, as I go up another point, we see the gamma is 11. It's additive because it's positive, so it's going to go up to roughly around 87, 88. And you see as it keeps getting deeper in the money, it goes up less and less. If we keep going, you're going to see it approach. Once it gets very deep in the money, especially close to expiration, delta is 100, which means it's going to go 1 for 1 with the share price. As we drop back down, okay, now we're since we're going back down, even though the gamma is positive, we have to subtract it. And you'll understand this more later. It actually flips the sign. So we're going down. You have to now subtract the gamma. So as I go down a point, this is going to go closer to 95, or 93. It's going to go a little more as we're going back down. So this is going to go roughly to, 88 level, 87. There you go. Going back down, 78, 65, 50, this will be at the money again. So you can see how gamma, when you're going up with the direction of the market and it's a positive gamma sign, it's going to be additive. When you're going down, it's, even though the gamma is positive, you subtract because now you're going down. The opposite would be for a put position, and we're not going to get into all that now. Now let me go into why we're getting into this, because if I am a primary dealer or a market maker, a primary dealer or a market maker is going to have the opposite position of what the majority of the general public are holding or products they are selling. Okay, so let's just pretend this was a positive gamma as a market maker, and let's just pretend this is my position. I'm long, and I ramped up the quantity to 10 just so it's easier to show the hedging. Now, as a market maker or primary dealer, I want to be as close to delta neutral as possible. Why? Because it exposes me to risk, either upside or downside. If I keep hedging off my delta, then I can essentially get too flat, and essentially I make money by the option spread. And, there's nuances in if I have positive theta or negative theta, the time decay and everything else. Again, I'm not going to get into all that. But this is roughly a delta neutral position. A delta of 5 is pretty close to delta neutral. And this is an at the money, and this would be a straddle. Let's say I'm a dealer that owns a straddle now, which means I want to keep hedging. So you see I have positive gamma. As this goes up, see, again, we had 310, so this is going to go over 300 and 306. Now, since it rallied up in my delta, now this is making me money, but I'm not trying to make money on direction as a dealer or a market maker. So that means I have to hedge off. How do I hedge off? Well, I'm going to sell 300 shares of stock. That takes me back to roughly a break-even delta, 0 delta. Okay, we go up again. I still have positive gamma. Now my delta again is 264. I need to sell more shares. Let's just say I sell 300 shares again. I mean, I could sell 260. I'm just going to go off 300. So my, sorry, I had to go to 600, 300. There we go. So now I have 600 total short. I have still slightly short delta. My gamma is still positive. So as this keeps going, see my delta is going up again. Up again. Now I have to sell about 300 more shares. That takes me to minus 900 to get back to delta neutral. So as the market's going up, I'm selling shares or futures contracts, whether you're selling shares short, or let's just pretend this was futures, or if even in the options for the indices, well, I'd be hedging with the futures because you can't sell an index. Or you could sell a basket of stocks that mimics it, but generally you're going to be trading the futures. So as it's rallying, I'm having to sell into the rally. as a dealer or a market maker, which means my price action is not reinforcing the rally. I'm actually selling. Now imagine this is huge quantities across all the dealers. It's rallying with positive gamma. They're actually selling into that rally. All right. So it's sort of dampening the rally. It's putting a constraint on the rally. And then going back down, let me get back to, sorry. Got a little ambitious there. Let me get back to 250. Conversely, and let me take off my hedge. If this was dropping with positive gamma, now that's going to be subtracted. The market's dropping, so I'm going to be subtracting gamma. So my delta is going to go negative as the market drops. See, delta negative close to 300. So what do I have to do as it drops? I have to buy 300 shares to get back to delta neutral. So the market's dropping, but I'm buying into the drop. So it's dampening the move down. Okay, drops again. Now I'm getting longer, so now let's just go exactly. So my delta is minus 261, so I'd have to buy 260 more shares. So this time we'll do it a little more accurately. So now I'm up to 560. 560, you see, roughly delta neutral. It drops again. Again, my gamma is still positive, but I have to subtract it. So I'm going to go down to roughly a minus 200 delta, which means I have to buy 200 more shares. So the market's dropping, I'm buying more and more. 760, again, taking me back to roughly delta neutral. Again, dampening effect. Take this on a macro level. Tons of dealers, market makers, these are the positions they have going into option expiration. They're counteracting the move with their buying. It's dampening. It's like a shock absorber. Okay, it's actually a negative feedback loop, which is what a shock absorber is, or for engineers, you know, that's how an elevator slows down, whether going down or up. It's actually a negative feedback loop. It just doesn't come to an abrupt halt. Just like your shock absorber, if you hit a pothole, the car oscillates. You might not feel the vibration, but it oscillates back and forth to dampen the effect. It just doesn't stop. If you stopped it suddenly on the rebound, you'd break car parts. You'd break possibly axles or your suspension. So that's a negative feedback loop. Now, what is let's take the opposite, a negative gamma. So negative gamma is the exact opposite here. If this was my negative gamma position, let me get back to 250. So you see, gamma is now negative. Delta is roughly 0, minus 5. Again, you have to roughly do it, but anywhere around 0, you know, even to plus or minus slightly is delta neutral. Now, as this goes up, so we're going up to 250 to 251, you see this is making my delta more negative because you have to add this. I'm going up, so you're adding the gamma. Gamma is a negative number, okay? So if I'm adding this, I'm adding negative 310 to negative 5. So it's going to come up, you know, roughly around just above that minus 300. So you see now, what do I have to do? The market's rallying. It went up, and I'm getting shorter with my delta. What do I have to do? I have to buy 300 shares, or I have to do the equivalent of the futures. That takes me roughly back to delta neutral. So as the market's rallying, I'm buying more into that rally. That amplifies the rally. That's a positive feedback loop. Like imagine a resonant frequency from an engineering standpoint, or Tacoma Narrows Bridge. Look it up, Google the video. I'm sure you all see the wind under it was a positive feedback loop. It actually amplified the oscillation in the bridge until the bridge blew itself apart. So what's happening here, and this is an aspect of gamma squeeze, is what happens in stocks, which I've done in a prior video, where your market makers in a certain stocks, they're really short a lot of the options. As the stock rallies, their delta is getting more and more short, so they're actually having to buy into that rally. I'm having to buy into this rally with this position. So I saw it go up, and let's see, right now my delta's hedged roughly 0 again, but I know, look, as it goes up another point, it's going to drop. I'm going to add negative 285 roughly to the position. So now you see I'm down to negative 264. And remember, it's not exact because we're going up whole point values at a time. But at minus 264, essentially, I have to short another, we'll just call it 300 shares again. So I'm going to go long. I'm going to have to buy another 300 shares. So now I'm going to go to 600 shares long. So I'm roughly delta neutral, again, slightly delta positive, close enough. But if it goes up, so I'm buying into this rally, it goes up another point, I have to buy more shares. As this keeps going, I'm having to buy more shares. And it's already rallying, whether it be a stock or the index or the futures, it's already rallying. Now I'm adding to the rally effect. Because now instead of 600 long, to get back, I'm going to go buy another 150 shares. Back to roughly delta neutral. But it keeps going. Look at this. Boom. Now I have to buy another 130 shares. So I'm amplifying the rally. I'm having to buy as the market's rallying. I'm buying more and more. So as a primary dealer or market maker, I am buying into the rally. I'm actually supporting the rally. Conversely, to the downside, let me get back to 250. And I'm sorry this is a bit complex. Stick with me through the wrap up because you'll understand how it affects your trading and ways that this will make you a better trader. Roughly delta neutral. We're going to drop now. So I'm going to go to 250, 249. We're going down. I have to subtract the gamma. So subtraction of a negative makes it positive. So my delta is going to go positive. So I'm dropping. You see it went up to 298. What does that mean? In order for me to hedge to get back to delta neutral, I have to sell short 300 shares, or if I'm trading the futures, just sell futures. See, now I'm roughly back to delta of 0. However, it drops again. Oh boy, now I got to sell another 260 shares. So that takes me up to 560 short to get me back to delta neutral. So as the market's dropping or the stock's dropping, I'm having to buy more. So it's counteracting that drop effect. I'm buying into the drop, so it's actually sort of providing more stability. Again, negative feedback loop. It's dampening the effect. All right, drops again, 247. I'm now have a positive 200 delta. I actually have to buy 200 more shares. And it just keeps going, okay? Now, what is a delta flip? We hear about that, and delta flips are very important for expiration. So a delta flip is, let me show you right here, right? We're at 250. Actually, let me show you this way. We'll go positive 10, positive 10, minus 10, oops, minus 10, minus 10. And I hope you can see how this macro option spreadsheet is so handy. Don't worry about the delta right now. It's 0. Just really watch the gamma. And again, we can hedge off, but watch the gamma as I go up. So this is what happens with a gamma flip. And this, pretend this is a macro position across a lot of dealers going into expiration. So initially you see the gamma positive. The market's going up. Goes up. You see how this went up to 250? So if I have to hedge off, I have to sell, right? 250 shares to get back to delta neutral. If I put in here minus 250, see here, delta neutral again. So I'd have to keep doing that as it goes up. But watch something here. I'm not going to hedge off every one. I just want to show you what a gamma flip is. As it keeps going up, gamma is still positive. Delta is getting bigger. Gamma is still positive, but it's getting smaller and smaller, and delta is getting bigger. Ooh, gamma flip. Gamma flip. What does that mean? Now the gamma is negative. That starts unwinding my position. So pretend I hedged. Let's just take this as a point in time. I had to get back, be at delta neutral right now. I have to be short 500 shares approximately. Let's go minus 525. That's going to take me to, oops, not, I did minus 525. There we go. So you see delta neutral. But now my gamma is negative. Watch, it's going to go the opposite. So I actually have to unwind my hedge. It went up again, And instead of it reinforcing, instead of me having to get longer and longer, I'm getting shorter and shorter. So now I have to unwind my hedge by approximately 80 shares. All right, let's just take this to, instead of being short 525, let's just call it I'm now short 450. Roughly delta neutral, but it keeps going. Now it's rallying. We've had a gamma flip. So instead of me selling into the rally, now I'm having to buy back into the rally. Okay, so now I'm negative 121, so now I actually have to buy another 120 shares. So instead of being short 450, now I'm short 330. All right, that's to get me back to delta neutral. So now I'm buying into a rally at this point because of the gamma flip. So you can see even as I go back down, and the opposite would happen going down. Again, I have a positive gamma, but I'm going down, so this is going to get me more negative. You see my delta is minus 250. So what do I have to do? I have to buy 250 shares. So now the market's going down, but I'm having to buy shares. So it's a dampening effect. Okay, go down again. I have to buy 200 more shares. Goes down again. I only have to buy 100 more shares. We're getting closer to that gamma flip again. Let's go down one more time. And look at this. My gamma has flipped to negative. So I'm close to zero delta. I'm not even going to hedge that off. But now if it keeps going down, I have to do the opposite. So it goes down. Look, I'm getting longer as it's going down. What does that mean? I'm actually now selling into the decline because I have to unwind my hedge. So instead of being long 550 shares, I can only be long 450 shares. So that means I sold 150 shares. Back to delta neutral. But now I'm selling into a decline. So because the gamma flipped, now I'm amplifying the decline. So before I was buying as the market went down, now I'm actually having to sell as the market goes down. Why gamma flips are so important? Because, all right, before going in expiration, great. We're in a range where I have positive delta on. I have to do one thing. It flips to negative delta just because the price crossed the threshold. Now I have to do the exact opposite. So as a buy, prior to this, I was on dips. I was buying into the dip to get back to delta neutral. Now, since we had the gamma flip, I'm actually having to sell. It goes down another point. Now I'm negative, or I'm positive. I got another 120 delta. So what do I have to do? I have to buy back roughly another 120 shares. See, that gets me, I'm sorry, not buy back. I have to sell another 120 shares. And this is why it can get confusing. I mean, I can even talk incorrectly about it. It's sort of a tough concept to get your head around. That's why using something like macro option to help model it, you can see I'm back to delta neutral. I'm only long 330 shares, but at the peak, I was long, over 500. So I'm selling as the market's going down. Again, we go down, let's just do it 2 more times or 3 more times. I'm now long 270 deltas. I have to roughly sell 280 shares. So that's going to only leave me 50 shares left to get me back to delta neutral. It keeps going. It keeps going. All right, I'm positive 47 delta. I have to unwind my whole hedge. Now I'm roughly delta neutral. But if this were to keep going, as you see, we're running out of room here because I'm getting so deep in the money with this position that the delta keeps getting smaller and smaller. But I'm actually having to now, offset this still. So that is the key aspect. So what's the takeaway? Well, depending on the dealer, where they are located, you have to understand whether they have to counteract the move with a negative feedback loop, like a shock absorber. So as the market rallies, they have to sell into the rally with futures or stock, or they have to buy into a dip. That's the negative feedback loop. That's counteracting the rally. Now on Friday in January, options expiration, we were in that negative delta position. That actually amplified the move because now they're going with the move. So if the market was selling, which it was doing, they're actually getting more and more short as the market's going down. And as the market was going up, they had to get longer and longer. And the downside bias was to the short side. So it amplified the move, that option expiration. Now, there was a a gamma flip, but it never got into that gamma flip. If it had gotten to that gamma flip area, they would have had to do the opposite. So if the market rallied and the gamma flip was higher than where we were trading on Friday on options expiration, so initially, if it started rallying, they would have been buying into that rally. However, if it got above the gamma flip, they would have been then had to become net sellers into that rally to properly hedge. So that would have put more of a dampening effect on. We never got to that gamma flip, and we traded down. We had some brief rallies, but we traded down most of the day. So they were actually amplifying the position because as the market declined, they had to sell into those declines to further amplify the declines. Watch this a couple times. I'm going to cut it off here again to try to not make it more complex than it already is. But these are great ways you can start to understand. So the key takeaway, if you're starting to see stuff, whether it be, in news stuff you're following or on Twitter or in any fintech stuff, and they're talking about negative gamma versus positive gamma and gamma flips, you can roughly understand, okay, is this going to reinforce a move on expiration or is it going to decrease? And it's not just on expiration. What I'm talking about expiration right now is the moves are amplified. The closer you get towards expiration, the moves are amplified. So especially understanding going into options expiration, if we're in positive gamma territory or we're in negative gamma territory and where the gamma flip is very handy to help analyze what the market's doing and whether the primary dealers and market makers are going to amplify the moves or put a dampening effect on the moves. And if they're like amplifying the moves, where it could possibly flip to a dampening effect, or if they're dampening the moves, where it could possibly flip to a amplifying aspect. Sorry about the complexity of this. I hope you were able to follow along. Again, watch it multiple times. This is very valuable information. It's an advanced topic, but even if your only takeaway is understanding amplifying versus dampening effect and what the flip means and how it can flip from one to another, then that should be your key takeaway. I will talk to everyone later. Have a great day, and bye for now.